Whether you're a seasoned investor or just getting started, these three ETF or exchange-traded funds are probably on your short list, and that's because they are some of the best performing ETF that you can get. And that's why I'm going to compare these popular ETFs based on 4 different criteria, which is total performance, risk, holdings, and valuation. By the end of this video, you'll either have a better idea of which ETF is best for your portfolio, or if you plan to invest in all 3, then you may want to weigh them differently based on your investment objective. As a quick tease, if you had invested $100,000 into each of these ETF 10 years ago, one of them would have earned nearly twice as much as the other 2. So let's get started with the basics. VOO is the Vanguard S&P 500 ETF, and it's an exchange-traded fund that tracks the performance of the S&P 500 index, which consists of 500 large-cap U.S. companies. It has a market cap of $95.9 billion, and it's one of the most popular and low-cost ETFs that provides a broad exposure to the U.S. stock market. Next is the VGT, or Vanguard Information Technology Index Fund, which is a fund that tracks the performance of the MSCI U.S. Investable Market Information Technology 25/50 Index, which consists of 331 U.S. companies in the IT sector. VGT has a market cap of $57.8 billion and is one of the best performing and high growth ETFs that provides exposure to the tech industry. And the last fund is SCHD, which is Schwab US Dividend Equity ETF, and it's an exchange-traded fund that tracks the performance of the Dow Jones US Dividend 100 Index, which consists of 100 US companies that have paid consistent and high dividends, where it has a market cap of $26.6 billion. SCHD is one of the most attractive and stable ETFs that provides income and value to investors. Now here's a quick snapshot of each ETF, its current traded price, expense ratio, and dividend. And as I always try to point out, please keep in mind that the total returns that I review take into account the expense ratio, and it assumes that the dividends are being reinvested. And from this, you can see that SCHD is the dividend leader, and they're all great funds when it comes to their low expense ratios. In this section, I'm going to compare the risk metrics of these 3 ETFs, such as the standard deviation, beta, and maximum drawdown. I'm going to explain what these metrics mean and how they measure the volatility and the risk-adjusted returns of each ETF. Let's start with a standard deviation, which measures how much the returns of an ETF deviate from its average return over a given time period. A higher standard deviation means that the ETF has more fluctuations and uncertainty in its return, while a lower standard deviation means that the ETF has more stability and it's consistent with its returns. Generally, a higher standard deviation implies a higher risk, as it indicates that the ETF is more prone to experience extreme gains or losses. Here are the annualized standard deviations of the 3 ETFs over the past 3 years. As you can see, VGT has the highest standard deviation among the 3 ETFs, which means that it has the most volatility and uncertainty in its returns. This is because VGT invests in the IT sector, which is known to be highly cyclical and sensitive to the market conditions, consumer preferences, and the new tech innovations. VGT can experience rapid growth and expansion, but it also has the sharpest declines and the sharpest contractions. And on the other hand, SCHD has the lowest standard deviation among the 3 ETFs, which means that it has the least volatility and uncertainty in its returns. This is because SCHD invests in high-quality dividend-paying stocks, which tend to be a little bit more stable and resilient to market fluctuations. This ETF can provide steady income and growth, but it also has limited upside, but it also minimizes the downside. Next, let's look at the beta, which measures how much an ETF moves in relation to the market. The market is represented by a benchmark index, such as the S&P 500 index. A beta of 1 means that the ETF moves in sync with the market. A beta of more than 1 means that the ETF moves more than the market, and a beta less than 1 means that the ETF moves less than that market. Generally, a higher beta implies higher risk, as it indicates that the ETF is more exposed to the market fluctuations and its shocks. And I realize this is relatively technical jargon, but I hope that this helps explain some of the investment terms that you should be researching on your own. Here are the betas of the 3 ETFs over the past 3 years, using the S&P 500 index as the benchmark, which explains why VOO is at exactly a 1. As you see, VGT has the highest beta among the 3, which means that it moves more than the market itself. VGT can amplify the gains and its losses of the market, depending on the direction and the magnitude of the market movement. The highs are exceptionally high and the lows are equally as extreme. And then on the other hand, you have SCHD, which has the lowest beta among the 3 ETFs, which means that it moves less than the market. This is because SCHD invests in those high-quality dividend-paying stocks, which tend to be less correlated and reactive to the market conditions, the consumer sentiment, the preferences, and the tech innovations. And the last risk metric that I'm going to be comparing is the maximum drawdown, which shows the biggest drop in the value of an ETF from its highest point down to its lowest point over a given time period. Having a higher maximum drawdown means that the ETF has gone through a larger loss and a deeper decline, while a lower maximum drawdown means that the ETF has gone through a smaller loss and a shallower decline. Generally, a higher maximum drawdown indicates higher risk, as it shows that the ETF is going to be more vulnerable to face severe and prolonged downturns. Here are the maximum drawdowns of these three ETF over the past 10 years. And from this, you can see VGT has the highest maximum drawdown among the three, which means that it has gone through the biggest loss and the deepest decline. And this shouldn't be a surprise because it is more of what we would expect from what I've spoken to, with VGT being a higher risk to reward ETF. And of course, on the other hand, we have that SCHD, which has the lowest maximum drawdown among the three, which means that it's gone through the smallest loss and the shallowest decline. SCHD has been affected the least by market crashes in 2011, 2018, and 2020, when the dividend-paying stocks often fell by less than 20% due to their defensive and stable nature. And of course, keeping with a consistent message, VOO is right there in the middle of the pack with its drawdowns, but honestly, it's not that much lower than VGT. The public markets always come with a trade-off, so diversification is a must to limit your volatility and your exposure, and ETFs are one of the best ways to do that. Now, I realize you're tired of hearing me say diversification, but that'll make the sting even worse if the markets recede in 2024. And can you really afford to take that risk? I feel it's best to be objective and keep with the facts. And the new UBS numbers state that multimillionaires are investing 30% of their portfolios, on average, in fine art. Why? It's the one investment they say that interest rates don't affect. Because while every other market has been underwater at some point in the past year or two, Masterworks hasn't taken a loss yet. They're up to 16 exits, and every one of them has turned a profit. 17.6%, 21.5%, 35%, over $43 million in returns. Just look at these charts. Check out the site for yourself. Their track record is right there front and center, so go see for yourself. Over 860,000 and counting are on board, and the line's getting longer every day. So take advantage while there's still time. And please, use my special affiliate link in the description below that helps support the channel. Now in this section, I'm going to compare the holdings of the three ETFs, the sector allocation, and the valuation. I'm going to try to explain how the holdings reflect the investment strategy and the objective of each ETF. Now let's look at the sector allocation between all three. This shows how much each ETF invests in different sectors of the economy. A higher sector allocation means that the ETF has more exposure and dependence on that sector, and of course vice versa. As you can see, VGT has the highest sector allocation among the three ETF, which means that it has the most exposure and dependence on the IT sector, which can be highly cyclical and sensitive to the market conditions. And VOO does lean in quite a bit into the IT sector, and then it somewhat balances out to match the overall index. Now I'll move on to the holdings, or the companies that make up the ETF investment. And I love this next chart because it shows how each ETF overlaps with the same companies, where VGT and SCHD have the least overlap of just 1% of the companies. Then there's SCHD and VOO that have just over 10%. And then VGT and VOO have 36% of the same companies in each ETF. We'll definitely want to double click into this to see which companies exist in all three. Here's the listing of the top 25 companies based on VOO as the reference. And I think it's interesting that Broadcom and Cisco are the only two companies that overlap all three ETF. The next aspect of holdings that I'm going to compare is the valuation, which shows how much ETF invests in different types of companies based on their earnings, growth, and their price. A higher valuation means that the ETF invests in more expensive and overvalued companies, while a lower valuation means that the ETF invests in the cheaper and undervalued companies. Generally, a higher valuation implies higher risk, as it indicates that the ETF invests in more speculative and optimistic companies, while a lower valuation implies lower risk, as it indicates that the ETF invests in more conservative companies overall. There are many different ways to measure the valuation of an ETF, such as the price to earnings ratio, the price to book ratio, the price to sales ratio, and the price to cash flow ratio. And in each case, a higher ratio means that the ETF is more expensive relative to its earnings, book value, sales, and its cash flow, while a lower ratio means that the ETF is cheaper relative to those same items. And as we can all see, VGT has the highest valuation among all three ETF, which means that it invests in the most expensive and overvalued companies. This is because VGT holds some of the most innovative and disruptive companies in the world, such as Apple, Microsoft, Amazon, and Nvidia. where they all have extremely high expectations and projections for their future earnings, growth, and price. And of course, on the other side, when we look at SCHD, it has the lowest valuation among the three ETF, which means that it invests in the cheapest and undervalued companies. And once again, VOO is that happy-go-lucky option that is right in the middle. And the last part that we're excited to review is the historical performance of these three ETFs over multiple different time periods. From here, VGT has outperformed both SCHD and VOO over most time periods, delivering impressive returns ranging from 38% in 1 year all the way up to 19.6% over the past 10 years. And when looking at SCHD, it's underperformed both VGT and VOO over most time periods, delivering modest returns ranging from -4% in 1 year and all the way up to 10.4% in 10 years. This shows that SCHD has been unable to keep up with the fast-paced and dynamic market, which has favored growth over value and risk over safety. So back to my original graph at the beginning of this video. If you had invested in VGT 10 years ago, it would have had the highest return by nearly twice as much over the other two ETFs. But keep in mind that the past performance is not an indicator for future returns. Clearly, the performance comparison shows that there is really no one-size-fits-all answer to which ETF is better for you in your portfolio. Honestly, it really depends on your investment goals, your risk tolerance, your time horizon, and your personal preference. And I think that these three ETF were a perfect set to compare to give you a solid view of the options and to also explain some of the terms for gauging performance and risk. There's no one perfect ETF for everyone, but I'm hopeful that this comparison at least gives you a better sense for why one or all of these ETF may make more sense to you.